Good afternoon, everyone. I'm Jim Wilcox, and I welcome you to our session on forecasting inflation and output. When the COVID pandemic struck in 2020, forecasters could hardly be expected to know how much their forecast error distributions had changed. As it happened, both inflation and employment were higher than generally forecasted, and by considerable amounts. Before and after COVID struck, the Fed seems to have stayed with its view that the Phillips curve had become quite flat. Indeed, for almost 20 years before COVID, at least, the responses of inflation to swings in unemployment did seem weak, if not completely gone. Booms in the 2000s and in the teens, and even the Great Recession, had remarkably little effect on core inflation. And I think we yet have to fully understand what accounts for any flattening of the pre-COVID Phillips curve. Not surprisingly, perhaps, having concluded they faced a quite flat Phillips curve, the Fed and many of the rest of us attributed most of the post-COVID inflation to energy shocks and supply chain disruptions. Higher inflation rates that would be transitory and would subside as the ripples of those shocks faded. 50 years ago, Milton Friedman concluded that in the 50 years before that, the Fed, quote, almost invariably acted too much, too late, end quote. One reason for acting too late, then, and perhaps now, might be underestimating how steep Phillips curves actually were or are now. Underestimating how steep Phillips curves were or are might also lead to interest rate hikes that prove to be too much. Alternatively, too much too late might also result from underestimating how fast Phillips curves can shift. The Fed's oft-stated target for inflation is 2%. FOMC members' forecast for, quote, long-run inflation in the Summary of Economic Projections are apparently well anchored at 2%. Other forecasters widely forecast longer-run inflation of 2%. But in 2020, the Fed announced its revised policy strategy, which has come to be known as flexible average inflation targeting, FAIT, FATE. Now, my personal policy is not to succumb to fate, but that is the name of this policy. The revised policy added the term average, but Chair Powell has made it very clear that his, quote, averaging applies primarily, and likely only, to past inflations that are below 2%. As a result, the Fed forecasters and financial markets now seem to have well-anchored expectations that the average that the Fed uses for its inflation target will completely omit the first half of the 2020s, when inflation is clearly above 2%. To the extent that the FATE policy is credible, it would be surprising if expectations or forecasts of genuinely average inflation or expectations of inflation at some point in the future were anchored at 2%, which they seem to be. They might be well anchored, but it's surprising that they would be anchored as low as 2%. As for the revised policy achieving its goals so far, fate has been anything but accompli. Sorry. This morning, Peter Henry argued that extinguishing moderate inflation might be quite costly in equity valuations, economic growth, and time. In telecom and in transportation, and also in package deliveries, completing the last mile can be extremely expensive. So too, perhaps, for eventually reducing embedded U.S. inflation, for example, from 4% to 3% to 2%? If so, Fed transparency and credibility would be very well served by alerting the public that the last mile on the road to 2% may be very long and costly indeed. Our presenter in this session, Mickey Levy, is well known to audiences here at the Hoover Monetary Policy Conferences. He has a long record of research and papers on Federal Reserve policies and their effects. Mickey is currently the chief economist for Berenberg Capital Markets and is a visiting scholar here at Hoover. He is a longstanding member of the Shadow Open Market Committee and has often testified in Congress about matters macroeconomic and financial. As the lead discussant for Mickey's paper, we're fortunate to hear from Steve Davis. Steve is a senior fellow here at Hoover after having had a distinguished career at Chicago Booth. Steve belongs to the NBER and advises the CBO, as well as the Brookings papers on economic activity. In addition to his other research, we know him well for his research associated with the Economic Policy Uncertainty Project and the Survey of Business Uncertainty. Along with other important activities, Steve coordinates and organizes the annual Asian Monetary Policy Forum. Now, speaking of uncertainty, we'll turn to our presenter, Mickey Levy, who is well known for leaving very little uncertainty about his assessment of Fed policies. Mickey?
First, I'd like to thank very much John Taylor, John Cochran, and Mike Bordeaux for giving me this opportunity. Okay, so the title of my paper is The Fed, Bad Forecasts and Misguided Monetary Policy. I analyzed the Fed's inflation projections in its quarterly summary of economic projections since September 2020, and the key finding is the Fed made many errors in forecasting that resulted in misguided monetary policies. As inflation rose higher and higher, the Fed persistently projected inflation would fall back toward 2%, while dramatically underestimating the rise in interest rates that would be required to achieve their inflation projections. I then analyzed three sources of Fed errors: modeling and analytical, human errors, and institutional errors, including not heeding the important lessons from history. In summary, the Fed's poor projections resulted in a costly extension of the extensive monetary accommodation, and this contributed to misleading forward guidance and confusing communications. It enabled inflation to go higher and also inflationary expectations to rise. When we think about the combination of these bad forecast policy mistakes and then bank stresses, it adds up to a weakening of the Fed's credibility. And just the magnitude of the errors and the sources of the error, they suggest the need for a major review by the Fed to address its flaws and come up with corrective actions. The quarterly SEPs were introduced during the financial crisis in 2009. They were designed to improve the Fed's monetary policy deliberations, enhance transparency, and improve communications. As we know, they're closely scrutinized and used as forward guidance. They have not met their expectations, and they've really become a headache. The magnitude and persistence of the Fed's recent projection errors have proved very costly, and they really highlight a lot of the problems internally facing the Fed. Now, let's begin with thinking about the conditional aspects of the SEPs, and I've learned a lot about this from Charlie Plosser. who's driven home the conditionality. So the FOMC members, they submit quarterly projections for real GDP, the unemployment rate, and the PCE inflation based on what they perceive to be the appropriate monetary policy. The year-end federal funds rate estimates are supposed to be the monetary policy that participants or Fed members expect would achieve their inflation projections. Now, the dots do not align each member's forecast of inflation in the economy with their dot, and that creates, so the median dot has an aggregation problem, but yet it's still instructive and closely followed. Now, bunch of numbers here. The left, columns 1 and 2, this shows inflation both on the headline and core that existed at the time that the Fed made their SEP forecasts. And as you look down, you see in columns 1 and 2, inflation rose dramatically. So this is the inflation that existed at the time the Fed made its forecasts. As you can see, as inflation rose dramatically, say through December of 2021, the Fed, as shown in columns 3 and 4, increased their inflation forecasts to reflect what had already happened, to reflect, they increased their inflation forecast for 2021, but then look over at columns 5 and 6, for forecasting for the years 2022, they forecast inflation to come back down dramatically and then remain anchored in 2023. Another way to look at this table is look, say, across from June 2021. Inflation had increased to 3.6%. The Fed increased its forecast for inflation to 3.4% for 2021, but had it falling back to 2.1% in 2023. This pattern continued. A big shift occurred in the March 2022 SEPs, where inflation had reached 6.1%, 5.2% on the core. The Fed had then dramatically increased its forecast to 4.3% for 2022, but then had it falling back down to 2.7% in 2023. This illustrates the sequence of the Fed's SEPs. What's interesting is start out on the lower left, and you see the SEPs for September 20, December 20, and just as had occurred in the prior nearly decade, the inflation was below 2%, and the Fed had it forecast it would rise asymptotically to 2%. Then as inflation rose, and the dotted line shows the inflation at the time the Fed made the forecast, the Fed forecasts inflation to decline sharply. I just just to help your vision, I connected the dots, but the dots are for the year-over-year inflation, Q4 to Q4. And so this just shows as inflation rose, the Fed forecast that inflation would fall sharply. More recently, particularly since March of last year, the Fed has forecast that inflation is not going to fall all the way back to 2%. Okay. This table should really be, the title of it really should be Fed Projections of Inflation in Dots. Column 1 shows the Fed's, or the FOMC's, forecast of inflation for 2021. Column 2 shows the Fed's median dot And column 3 shows the range of the SOMC forecasts. So you can see for 2021, as inflation rose to 5.3%, not only was the median dot anchored to 0, but there was no deviation, and the highest dot was anchored to 0. 2022, column 4 shows the Fed's own projection of inflation for 2022, and you can start down at March 2022, where it forecasts 2.6% inflation, but the median dot was 0.9. And so if you read down column 5, or compare columns 4 and 5, you can see as inflation rose, the Fed estimated that the median dot, that is the appropriate federal funds rate, rose, but it never rose as high as the inflation the Fed projected. Only beginning in March of 2022 do you see in columns 7 and 8 did the Fed estimate that the appropriate funds rate was above the inflation it forecasts. Now, this shows a different angle. The upper left-hand panel for 2021 shows the Fed's forecast of inflation in black. In orange, it shows the median dot, and then the range you see across to the upper right-hand panel, the Fed's projections for 2022. And note that in this upper right-hand panel, while the Fed estimated a higher funds rate, not one member estimated that the funds rate would be appropriate to raise it as high as the inflation it forecast. So the basic observations are the Fed was overly optimistic on inflation, that it would recede rapidly toward 2%, and it significantly underestimated the Fed funds rate required to achieve its inflation forecast. And these inconsistencies suggest the Fed relied nearly exclusively on the argument that inflation was due to transitory supply shocks. And what's interesting is if you look through history, and Mike Bordeaux and I have written about this, 100% of the time in the past when the Fed got behind the curve and had to raise rates, it always raised rates above inflation. The Fed didn't see it necessary this time, and it maintained this forecast long after the evidence was merited. And of course, the lack of dispersion of views is quite striking. So let's consider the sources of the projection errors. And I understand this is speculative, but let's begin with analytical sources of errors. The Fed's Phillips model failed to predict the impact on aggregate demand of the unprecedented fiscal stimulus. Over $5 trillion, or 27% of GDP, in deficit spending with extreme monetary accommodation. The Fed effectively bought about half of the Treasury new bond issuance. Even the Biden's $1.9 trillion package, which was 10% of GDP, deficit spending in March of 2021 had very, very little impact, if any, on the June 2021 Fed SEPs, and the minutes of the June 2021 FOMC meeting barely mentioned fiscal policy. Money supply, M2, bulged 42%. Now, money supply is one of the variables that affects financial conditions, but is not really explicit in the Phillips model. And then the model, of course, incorporates the Fed's ability to credibly manage inflationary expectations such that deviations of inflation from 2% regress back toward the target. And then there's, in the neo-Keynesian nature of the model, it incorporates a Phillips curve. Now, with regard to inflationary expectations, so the Fed relies very, very heavily on managing inflationary expectations to achieve its inflation objective, and it presumed it could do so through forward guidance. But when we think about it, the presumption is that its model for projecting and achieving inflation works and is credible. And in fact, that was challenged and proved incorrect. So in order to be able to credibly manage inflationary expectations, you have to have a credible model for achieving your objective, and that was challenged. As inflationary expectations rose and became unanchored in 2021, the Fed failed to respond and continued to rely on forward guidance. And then finally, inflationary expectations did fall in 2022, but only when the Fed raised rates aggressively. And this just shows, policy actions speak louder than words and reveal the flaws in the Fed's, heavy reliance on managing expectations through forward guidance. Now, the Fed presumed that inflation would stay low, as it did following the great financial crisis. And this presumption just affected everything and all the research the Fed conducted. This was a short-sighted view of history. And what's interesting here, and Jim mentioned it, the heavy reliance on the flattening Phillips curve. And I think that's more of almost like an ex post explanation, when in fact there was such a dramatic difference between the GFC and the pandemic. The fiscal stimulus was magnitudes higher in response to the pandemic. Following the GFC, aggregate demand, nominal GDP, never accelerated above 4%, whereas it soared post-pandemic. Following the GFC, the banking and housing sectors were crippled. Balance sheets were impaired. Just the opposite post-pandemic. And then, remember, during the GFC, the Fed changed its operating procedures, including IOER and tightening of credit standards, and that may have affected monetary policy channels. So when we think about this presumption that inflation stayed low, when inflation did rise, it didn't fit the Fed's model, and the Fed was very quick to blame it on the transitory argument. And take a look at this chart on nominal GDP. This aggregate demand, as it was accelerating sharply, the Fed was still attributing the inflation to supply transitory factors. And now this just shows an angle on maybe the Phillips curve. You can see that amid accelerating inflation, and here I show the SEPs in June and December 2020. As inflation accelerated, the Fed projected inflation to decline sharply, while at the same time forecasting the unemployment rate to be materially below its estimate of the natural rate, while simultaneously estimating the appropriate policy rate below the inflation it projected. It just didn't seem to add up. Now, institutional error. The new strategic plan stands out like a sore thumb. As Charlie Plosser and I wrote, 1 month after it was rolled out, it prioritized employment, favored higher inflation, deep-sixed preemptive tightening, and all this contributed to the policy errors of 2021, 2022. As we know, the new strategic plan was driven by fears of lower inflation and hitting the effective lower bound. They were analytically flawed. Remember, preemptive tightening, was critical to the Fed's success during the Great Moderation. The flexible average inflation targeting favored higher inflation. It was overly complex, and it never provided any numeric guidelines either for the Fed or the markets. And then, prioritizing maximum inclusive employment, while well-intentioned, it led the Fed to delay tapering and raising rates until it saw substantial progress on labor markets without telling any of us what substantial progress was. So there was this lack of diversity, no dissents in 2021, and then significant failures in risk management, relying on the best forecasts without considering alternatives. And then even after the Fed dismissed the transitory term, it continued to rely on negative rates and ignored the guidelines provided by Taylor rule estimates. Observations on the banking crisis. The Fed was complicit. It didn't cause it. Banks used horrible risk management, but the Fed was complicit. It's delayed exit. It's misleading forward guidance, and it's provided by its projections, and then aggressive rate hikes, higher bond yields. They really shouldn't have been a surprise, but they were. And what's interesting here is very similar to the FOMC, the Fed's bank supervisors and stress testers didn't consider the impact of higher inflation and higher interest rates. And so let me just conclude and say the Fed, it's essential that it conduct a review and address the sources of the errors. The Phillips model, it needs to address why didn't it capture the fiscal stimulus? Why doesn't it capture outsized changes in M2? It has to reassess inflationary expectations in a practical way. It needs to correct the flaws in its strategic plan. And then on the SEPs, has to clarify and emphasize the conditionality. I would strongly recommend using the Taylor rule to establish consistency between the Fed's forecasts and its federal funds rate projections. Consider alternative scenarios and provide information on the balance sheet, which it doesn't do now. It needs to encourage diversity of views within the Fed and consider ways to avoid institutional dampening of views. And then consider better ways to use the anecdotal evidence. What's so interesting is when you go back during 2021 and 2022, there was very rich information in the beige book provided by the Federal Reserve banks, and it didn't seem to carry much weight. And so the goal of this review is to improve monetary policy. Thank you.
Great. Thanks so much for having me here. It's a pleasure to address folks this afternoon. And it was a real pleasure to read Mickey's paper and to hear his discussion and prompt me to think about some things I haven't thought about before. So Mickey's paper does an excellent job of documenting the forecasting and policy errors that the Fed has made since late 2020. It's a summary of some of that here. And also the paper does a very nice job of trying to describe the various types of human, analytical, and other errors in thinking or analysis that led into the forecasting and policy errors. So they're summarized on this slide. I'm not going to go through them in detail, although I will come back to some of them. Now, having read the paper, I find little to criticize in either of those two parts, the description of the errors and the reasons why they happened. So it would not be much fun to stand here late in the afternoon and delineate my points of agreement. So what I will do instead is I'm going to try to build on Mickey's paper, and I'm going to advance an argument that basically says the Fed faced incentives that made it prone to make the kinds of forecasting and policy errors that it actually made during this period. And moreover, those incentives manifested themselves with particular force in 2021 and 2022 because of prevailing economic conditions. So that's the argument I want to advance. Hopefully I'll persuade you that there is an incentive problem here. And towards the end of my talk, I'll come back and offer some suggested reforms that would at least, in my view, mitigate these problems. So I'm going to start out very simple. by just describing the basic tension, a basic tension that I think colors certainly the Fed's projections, but that tension can also feed into its actual policy decisions. I'll do that in a simple setting in which it seems rather easy to address this tension created by the incentive problem I'm going to describe. But then I'll complexify things a bit and situate it in the context of 2021, 2022, where it's not so clear it's easy to resolve these tensions. So here's the basic tension. So I think basically every FOMC policymaker, certainly most, in fact most practicing macroeconomists and monetary policy experts subscribe to these two statements. Expected inflation affects actual inflation. That's statement one, or proposition one. Notice that's a feature of any Phillips curve with a forward-looking element in the expectations term. And second, that Fed projections influence expected inflation. So if you accept those two propositions, and I'm going to take them as kind of axiomatic of the way the Fed approaches its thinking about monetary policy, and again, many of, not just the Fed, but most practicing macroeconomists, there's an incentive to distort the inflation projections, at least when inflation's above target, so as to bring the inflation rate down at a lower cost. In other words, to achieve the Fed's mandate at a lower cost by working through the effects of projections on expected inflation and expected inflation's effect on actual inflation. Of course, if the Fed distorts its projections in any kind of systematic or regular way, that's going to undermine its credibility as a forecaster and its reputation for honest communications. So I think this temptation to distort the projection is probably easily controlled in normal times, okay, by these desires for credibility and honest communications. So let me give a fuller statement of this. So that's the basic tension. And notice that tension gives the Fed an incentive to distort its inflation projection. But if you expand that statement a bit, okay, I've now modified the second statement to basically say, look, the Fed does a bunch of things that effectively are forward guidance. It's not just explicit forward guidance, not just the Fed's projection, but even its choice of headline models, the design and the features of those models, like the Phillips, and the way it's designed effectively communicates something to the rest of the world about how the Fed thinks about the inflation process. The Fed will understand that, of course. And so the design of its headline models will be something of an instrument, a forward guidance instrument, among other forward guidance instruments. The third point here is just, again, I think a non-controversial proposition, but it's worth stating it, and that is that the future conduct of monetary policy affects future inflation. Well, an immediate corollary to that is expectations about the future conduct of monetary policy affect expected future inflation. Well, notice that also creates a tension not just with respect to the projections for inflation, but with projections about the Fed's own future policy rate, okay? It understands that those projections have the potential to influence expected inflation and thereby to influence actual inflation in the near future, okay? So that's the tensions or the incentive issues facing the Fed. Now, let's think about the circumstances that prevailed in 2021, 2022, and even late 2020 that intensified the force of those incentives to distort inflation projections and policy rate projections. First, inflation had begun to exceed the desired rate after a very long period of inflation at or below the desired rate. Second, I think there was genuine uncertainty about the persistence of undesirably high inflation, absent some tightening of monetary policy, and also the extent and duration of any tightening that would be needed to restore inflation back to some desirable level. And that uncertainty remains today, as you can tell from many previous remarks at this conference. So if you think about it, these incentives intensify these conditions intensify the incentive of the Fed to distort its projections about inflation and the future policy rate. Why? Because to do otherwise is to effectively validate narratives that run contrary to the Fed's preferred narrative. The Fed's preferred narrative then, and perhaps even now to some extent, is that these inflationary forces were inherently temporary and self-correcting, okay? And Mickey's discussion makes that point quite clear. So in this situation of inflation above the desired level, a view which was at least plausible, certainly was plausible enough that it was espoused by most monetary policymakers, that inflation would naturally tend to return to a desired level without much of an aggressive response by the Fed. You don't want to validate alternative narratives that would add to inflationary pressure. Now, one more notable circumstance, and here I will quote Rich. Rich, I'm not sure where you are in the audience. Rich. Okay. So this is I'm going to quote Rich from when he was in his capacity as vice chair of the Fed. And I picked this quotation because he highlights a third feature that he characterized as quite important in thinking. So the first part of this quotation kind of just a restatement of things I've already said. It's the part in green that is an addition to what I said before. And so he's basically saying, look, the desire to rely on expected inflation and things that anchor expected inflation and thereby feed through to actual inflation are particularly true in the world that prevails today with flat Phillips curve, in which the primary determinant of actual inflation is expected inflation. I guess I'd put that as if you can't rely on the slope of the Phillips curve, what else have you got besides manipulations of expected inflation and hoping for favorable supply shocks? That's about it. So again, in this setting, validating contrary narratives that have the capacity to undermine the anchoring of expected inflation, it would be rightly seen as quite a dangerous thing for the Fed to do, okay? So I've now described these three circumstances that made 2021, 2022 unusual in that they added extra force to the incentives facing the Fed to distort its projections and probably internally its own thinking about future inflation and about the extent of monetary tightening that would be needed in order to bring inflation back down to acceptable levels. So what I'm going to do now is kind of show you some evidence that kind of reinforce this view or try to support this view, and I want to also draw out more fully than I have so far how these, I'll call them bad incentives for short, can play out in harmful ways. So, I think Mickey made the point in his remarks, and it comes through very clearly in his paper, that the Fed relied quite heavily, and this is also consistent with the quotation I just read from Rich Clarida, that the Fed was thinking quite carefully about, quite hard about using management of expectations as a tool to help achieve its monetary policy goals, especially with respect to inflation. So that was a key part of the Fed's thinking, and I hope you've understood from what I've said so far that the Fed had strong incentives to think that way and to persuade others that that's the right way to think. Now, here's words from another former central banker, Mervyn King, that have some of the same flavor. I'm going to read this. We are told that this burst of inflation is transitory. He's former BOE governor at this point, so he's criticizing from the outside. And for several years, central banks have been giving forward guidance that interest rates will remain close to or below zero for the indefinite future. This policy stance relies heavily on the assumptions that expectations drive inflation and central banks drive expectations. In other words, longer-term inflation is determined by the official inflation target. In some sense, that's just a restatement of those key propositions I put up before, okay? And this is in the context of an article that's pretty critical of central banking at the time, as you can gather by the title of the article, The King-Canute Theory of Inflation. Now, let's think about the choice of the headline models. We heard some criticism of Phillips from Mickey. There's a lot of it in the paper. There's, I think, other remarks. And the particular thing about the Phillips model that I want to draw attention to is captured by this quotation. So the Phillips model presumes that inflationary expectations are anchored to the Fed's 2% longer run inflation target, such that increases in inflation above 2% naturally tend to regress back to 2%. And the fiscal part is just a corollary to that. It's not my main point here. But what do you expect from the Fed? Especially, what do you expect from the board? So consider the reaction if back in 2021 or early 2022, the board staff suddenly came out with a model that did not have a strong anchor for inflation expectations. Okay, just imagine that had been their reaction. People would have taken notice, and I think FOMC members would have viewed, reasonably so, that move as harmful to their efforts to achieve their mandate at a low cost, because it would have run the risk of validating these narratives that saying inflation isn't so well anchored. So the point I'm making now is that the incentive problems I've described extends even to the models that the Fed uses to justify its policies and explain itself to the rest of the world. You know, Mickey talked about the persistence of these forecast errors and the loss of credibility that came with it. Well, I think that's a natural corollary of the argument that I'm making, that the Fed had reasons to stick with this narrative about self-correcting transitory inflation, because to do otherwise had the potential to undermine its efforts to achieve its mandate at low cost. And just to be clear, if it's not already from what I've said before, when I say achieve its mandate at low cost, I mean without having to explicitly raise the policy rate by a few hundred basis points in a way that has the potential to trigger a recession and slow down the economy. Now here's a quotation from another central banker. This is from Mickey's paper, but I want to draw it out more fully. It's about doubling down on this transitory narrative. So Governor Waller makes the following comments, and this is in January 2023 where he's looking back. He says, "The mistake in my mind that we made was we bet the farm on the transitory story." Again, reiterating the point I've been trying to make about the Fed had reasons to be locked into this story about transitory self-correcting inflation. And he goes on to say, in any risk, and he's criticizing himself and his colleagues, in any risk management model, you would have said, what if it doesn't go away? What should we be doing to get ready for that event if it doesn't go away? That seems like impeccable logic from a risk management perspective, and it is. But notice again that if the Fed steps towards this sound risk management approach to the conduct of monetary policy, it is implicitly validating narratives that put some weight on the idea that inflation can become unanchored in a serious way, and for a period of years at least, be above the desired rate. So I think, much as I agree with the idea of risk management, the argument I'm making about the incentives facing the Fed discouraged the Fed, especially during this period of genuine uncertainty, discouraged the Fed from pursuing that kind of sound risk management. So another point, I've talked all about the incentives within the Fed so far, but these incentives diffuse not just within the Fed, but beyond the Fed into the rest of the world. They diffuse, the story I'm telling here applies not just to the Fed, but to many other leading central bankers. So we can expect this incentive problem, if you buy my argument about it, will be widespread among central banks around the world. And because so many professional forecasters and Fed watchers come from careers in the central bank, and their thinking has been shaped by their careers in the central bank, it's quite easy to see how the same incentive problems that underlie thinking and model design and so on will diffuse well beyond central banks themselves. So that's my diagnosis of why the Fed and other central banks were prone to make the kinds of forecasting and policy errors that they made since late 2020. So, but incentives are not destiny. That's the point. That's not the end of the story. So I want to offer some hopefully constructive suggestions. First thing is, if you have an incentive problem, the first step to resolving it or mitigating its bad effects is to recognize and acknowledge the problem. Okay, so we'll see. There's many monetary policy experts in this audience. We'll see whether I've persuaded anybody that there is a problem here. Further steps require institutional change. That's hard, but let me make an attempt at 4 suggested reforms. Now, the first one involves how the Fed makes its projections. And I want to preface my remarks on this first one with a few preliminary remarks. First, what I'm going to propose is not going to fully resolve the incentive problem I describe. It will mitigate it, I think, I'll argue. Second, this first reform that I'm going to suggest is not motivated just by the incentive problems that I've described so far. You know, I have not, before reading Mickey's paper, had any occasion to think carefully about the Fed's economic projections and the conditional nature of them. I'm not really a card-carrying member of the Monetary Policy Club. Having had an occasion to read about how these projections work and think about them, they strike me as quite odd and poorly designed. So here's my suggestion for how to redesign the way the Fed performs its projections. So replace the current projections conditional on each FOMC member's estimate of the appropriate monetary policy, which is quite a vague concept, with projections that are conditional on specified trajectories for the policy rate and other policy instruments. And the board staff would be responsible for specifying a baseline monetary policy trajectory, at least one materially looser policy trajectory, and at least one materially tighter policy trajectory. And they could specify other assumptions too, like, you know, what's the fiscal authority going to do over the relevant horizon? I would give the regional, and all of the FOMC members would then make projections conditional on each of these monetary policy trajectories. I would let the regional feds supply projections conditional on other policy trajectories if they wish. Okay, so they're going to supply projections conditional on the ones designed by the board, but they can add others, which is a form of discipline on the process. So here's what I think are 5 advantages to this approach relative to the current one. First, it clarifies the policy assumptions behind the projections. Okay, it's not at all clear, what appropriate monetary policy means. It probably means something different in the minds of every FOMC member. Second, it simplifies the aggregation of projections. When you don't even know exactly what policy assumptions are conditioning each of the projections, it's very hard to aggregate over the projections of the different FOMC members. Third, it doesn't eliminate, it lessens the incentives to distort projections and ratify, and it says the Fed's view, but I should say the board's view about the economic outlook. This baseline policy trajectory that the board puts forth is still going to have aspects of forward guidance to it, but at least they're being compelled to put other trajectories out there, and the option that the regional feds have to offer other trajectories is a form of discipline on what the board does. Thank you. Fourth, it reveals what each FOMC member believes about the output, unemployment, and inflation effects of deviations from the baseline policy. I don't see how you can elicit that information from the current projections, but it seems like a fundamental thing you'd want to know, because it's telling you about the model that these FOMC members have in their heads as to the effects of monetary policy. And fifth, I've kind of already indicated this, it lets the regional feds softly dissent from the board view by offering projections conditioned on other policy trajectories. Now, that's not going to fully resolve the incentive tension that I described earlier. I think it would help. So let me I think I'll make 2 other suggestions given my limited time. The Fed should sponsor an annual conference that highlights tail risks for monetary policy and central banking, advances non-standard scenario analyses, considers emerging and latent threats to sound monetary policy, and draws lessons from historical episodes. I know the Fed sponsors a lot of conferences already, but I'm suggesting that the Fed doesn't control the agenda for this one. They pay the money, but the agenda is set by an outside scientific committee. Most of the paper authors should be drawn from non-Fed economists. Most of the discussants should be Fed economists. It's a way to force them to engage. And I'd offer cash prizes for the most thought-provoking, innovative papers. You know, cash prizes that are big enough to actually get people to pay attention. Third point, last point I'll make. Yeah, I would separate business as usual forecasting inside the Fed from the assessment of recession risks, major inflation threats, and financial crisis risks. And the reason is because of the skills, the methods, and the data required for business as usual forecasting. They're different than those that are needed for other types of assessments. And so I may be in a minority among economists here, but I think historians have something to add, especially to kind of one-off and unique events, and bringing together information that's not very well incorporated into fully specified econometric or analytical models. That would be one type of different skill. So I'll stop there, and thanks a lot.
Thank you, Mickey, and thank you, Steve. We'll now take questions from the floor, and as usual, please identify yourselves.
Rich Claret at Columbia University. Always enjoy the Hoover conference, and Mickey wrote, as usual, a provocative paper. I have several comments. I've quit counting them, but I'll try to be brief. Number one, I think Mickey's paper explains too much in that it ignores the fact that there are 10 countries in the G10, and all 10 of them failed to hike rates before inflation exceeded target, and 8 of them failed to hike rates before core inflation exceeded target, the 2 exceptions being Switzerland and Norway. So there was something about the shock or about central bankers' interpretation of the shocks that put them behind the curve, and that's omitted from the paper. It's very Fed-specific. The second thing, which Steve touched on, is that, speaking for myself, I had 18 colleagues, but all throughout 2021, I was looking for private sector forecast at the high end and trying to look at appropriate policy under a plausible worst-case scenario. I'll give you one data point. In April of 2021, the Wall Street Journal surveyed 75 economists. This was after the American Rescue Plan passed. It's on the web. You can go look it up in every individual forecast. I'm not sure if you were on there, Mickey. And the median forecast post-American Rescue Plan in 2021 for inflation was 2.1, and the most hawkish pessimistic forecast was at 2.7. So there was an epic forecast missed here. It may be because forecasters were many former Fed officials. The break-even markets are different. Break-even markets are just about getting expected inflation right, and they also were not showing a surge then. So I think you need to step back a little bit on this. In terms of counterfactuals, it's hard to do counterfactuals honestly. It's easy to do them otherwise. There are 2 ways to do counterfactuals. One is to look at if policy had been sensibly run with the Taylor rule, and Papel has done that. And what you see is rate hikes would have commenced either at the July or September meeting of 2021. The Fed's new framework did lay out particular thresholds for liftoff, and those were met by November of 2021. So given the nature of the shock, it would not have mattered if policy had been outsourced either to a Taylor rule or to a mechanical application of the new framework. Clearly, the Fed got aggregate supply wrong. Wage inflation skyrocketed with an unemployment rate of 5% and millions of fewer workers than had been employed pre-pandemic. Broad-based price inflation picked up when the level of GDP was 2 percentage points below the then prevailing estimate of potential. So there was a huge supply shock in play. Demand was clearly ex post not in line with available aggregate supply, but I would fast forward to today. We are now 3 years after the pandemic and 2 years after the reopening. Core inflation in every G10 country save Switzerland. And I will say Switzerland's a nice object case because they had the same shock as everyone else. They import a lot of energy. And core inflation in Switzerland is 2.2%. So clearly there was something that could have been done that was done. But I would also argue that I think a focus on the Fed really misses the bigger picture of the shocks and the real-time policy response and where central banks find themselves today as we speak. And as for inflation expectations, by most measures, they have remained reasonably well anchored. Perhaps that's more a matter of luck than skill, but we should also be focusing on that. Thank you.
Jim Bullard, St. Louis Fed. I just want to emphasize that we should put 2021 into some context. There was basically no inflation in the first quarter and no inflation expected. Vaccines came in the second quarter, and at least for me, I wanted to see how the vaccines would proceed and whether they would be successful. By the time you got to July 1, you did have some inflation. The vaccines seemed to be pretty successful. The pandemic did not end cleanly there. There were other things happened in the second half of 2021. So I think that you have to have some context about the crisis going on. But my main point is that, as my colleague Chris Waller detailed here last year at this conference, moves were made in a hawkish direction during the fall of 2021. It's just that they're not visible in these charts because the projected date of ending the asset purchases was way off in 2024. That was reeled in during the fall of 2021. Ideas that we would raise the policy rate sooner rather than later was all being brought forward in time. This is pushing the 2-year yield up, as I emphasized last year. So I think hawkish moves were being made, but it shows you how the prior coming, as the pandemic hit, the prior was very strong that this was going to be the Great Depression and the economy was going to be very, very sluggish for a very long time and inflation was going to be very low for a very long time. All of that was being upset in 2021 and we were bringing a change to monetary policy, but it didn't manifest itself in liftoff until March of 2022, and then we started to move very rapidly in 2022 with the policy rate. But I just want to say that some things were being done in the fall of 2021.
Next is Andy, followed by John Cochran.
Of course, I agree with everything Mickey says. Steve, we could talk offline. I think Chris and I were kind of amusing because your recommendations are exactly the opposite of what Jordy Golly and Mike Woodford and Lars Svensson were all pushing central banks to do something, and the FOMC followed it. In a macro model, having an exogenous nominal interest rate actually is problematic. So we can talk about that offline. But what I wanted to respond to was, think about a team of medical doctors and a patient and the patient's family. I think it's a useful analogy to think about these communication issues. Because if we follow Steve's thing about incentives, the team of doctors would be constantly telling the patient, oh, don't worry, everything's going to be fine, just relax. Okay, and there are actually some times when the patient's really stressed where it's actually helpful for the doctors to reassure them. But there are also situations where the patient gets worried in the middle of the night, like maybe the doctor's not telling me everything. And if they feel like the physicians are not telling them the whole truth, that can also be very problematic. Now, the fact of the matter is, in the medical world, you have to prepare the patient for the possibility that they might need chemotherapy, that they might need surgery. And that's much easier if you're telling them further ahead to say, there's a risk here. We hope it won't be necessary, but just a heads up that could be coming. Or even that you may need to take this very unpleasant medicine for a few weeks, but you'll get past it. And I think what was missing, Steve, from your incentive story here is the other side of this, which was the old idea of we're going to warn the public that we may need to raise rates a lot, and there's going to be some short-term pain, but it's going to be worth it because we all want price stability over time. And I think the problem the Fed's still facing now is they haven't really clearly told the public, the Congress, or the markets that that possibility is still out there. And it makes me worry that it's going to get harder and harder and harder for the team of physicians that leads the economy to convey that message. Because it's like, well, wait a minute, how come you didn't warn us before?
Next is John Cochran, followed by Jeff Lacker.
Thank you, guys. This is great. We pushed you out in this panel for a reason, because I think this is so important to figure out what the heck went wrong. I just want to expand on some of the conceptual issues. And I'll phrase this as statements, but you can take them as questions and disagree with them. Now, of course, yes, the Fed's mistake was also repeated by all central banks around the world and by industry analysts. So the conceptual problems are common to lots of people. Here's a list of additional ones I think that went wrong. First, demand versus supply. To central bankers, demand and output are practically synonyms. Supply, if it's there, is vaguely out there somewhere. So if this was those supply shocks, well then where's the team of economists out there monitoring supply? They're not there. Well, if they were going to have supply shocks, maybe we need one. Second, fiscal. $5 trillion of fiscal stimulus. Why did this not show up anywhere? I have heard quietly some of the answer is, look, the Fed can't get involved in politics. That would be political. But nonetheless, the $5 trillion is going to show up on the inflation somewhere, so you have to consider that. The Phillips curve came up a lot here, and I think we're making some mistakes in how we think about it. In this discussion, as well in much of the Fed, it is taken as causal from output, and expected inflation determines current inflation. It's just a correlation. Maybe it's how inflation determines output. The Phillips curve is also not the whole model. Lots of other equations in our models have output, inflation, and interest rates in them. You can't just think in terms of the Phillips curve. I think we look too short-term. It's inflation equals expected inflation. So we go to, well, if we change expected inflation, that changes inflation. That remind you how finance works. Today's price is tomorrow's expected price plus the dividend. So if you're looking at a one-day horizon, you say to yourself, well, we can talk up tomorrow's price and that'll raise today's price. Well, iterate that forward, and of course, it's not about tomorrow's price. It's about the dividend. And I think looking a few more steps ahead in the game would be useful there. Expected inflation is not an exogenous variable. It's not something determined by speeches. It comes from a regime, not just something we can talk about. Anchored. Anchored by what? Anchored by more speeches about how important anchoring is? What I notice is a lack of what the anchoring that's needed. If it comes to it, we will replay 1980 if necessary. No matter how hard that might be. That relates to projections which are about time and not about data. Really, if you're saying it should be anchored because if it comes to it, we will replay 1980, you're saying we will respond to inflation, not here's what we're going to do next month into next year. Steve had a couple of important points which I want to emphasize in slightly different language. Number one, I've learned something at Hoover by hanging out with these military people who are fascinating. The Fed says, here's our expected path, and here's what we're going to do. No self-respecting military person would ever say, here's what we expect the enemy to do, so here's our plan, we're sticking to it. No! They go through 100 different, well, if he comes on the left flank, here's what we do. If the right flank, here's what we do. Where is the risk management? This is something Steve was saying. The risk management approach, the conditional approach, as opposed to the just stick your forecast. Mike Tyson said what happens if you just make a plan and go into battle with it. Similarly, the military red teams things. Here's our plan, here's what we think's happening, and there's a red team that's out there to poke holes in it. The Fed does not do red team, and I gather from people inside the Fed, disagreeing is not good for your career. Well, we need to change that. Likewise, the military, if they lose a battle, there's an inquest. How did we miss this? Well, we are starting to ask this question, but where is the inquest inside the Fed? Where's the court-martial? After Pearl Harbor, they didn't just say, well, it was a supply shock, I don't know what happened. They went and said, where do we, and that's important, maybe internally. Maybe whatever. As Steve points out, there is this incentive, and we've seen this with bank regulation, and we've seen it with the pandemic. Don't Don't frighten people. Okay, there are lots of conceptual issues, and I'm interested to what extent you guys think these are important.
Jeff Lacker, followed by Volker.
Jeff Lacker, Shadow Open Market Committee. So commend Mickey. I've been talking with him for months, knew what was coming in this paper, but it's wonderfully documented and dissected, and I think very, very incredibly useful. Steve Davis, your theory rings true. It's definitely the case for me that the Fed always felt as if, felt like Andy Levin's old-time paternalistic doctor that thought that the best thing for the patient was that they not know, what risks were out there. And to that point, the phrase risk management within the Fed, and I think you'll find this in the transcripts in the early 2000s, was a synonym for raising rates based on some something you choose now based on some probabilistic assessment, not really, what John was talking about in terms of military planning. So the SEP, I think, deserves to be dismembered and rebuilt from scratch. The SEP, I uncovered this sort of looking into the origin of the consensus statement in 2012. The SEP was introduced without dots and with a 2-year horizon, and it was done as a shortcut to an inflation target. The idea, the expectation, the hope at the board was that everyone would submit 2% or the same number for like the last year of the inflation forecast. That failed. They added a third year. That failed, and so they added this final column of long run, and then they added the dots were added later to provide a vehicle for portraying policy as lower for longer in order to pull the yield curve down to influence expected inflation. So the SEP was sort of built around trying to influence expected inflation, and I think it needs to rebuild. Now, there's always been a hesitance about letting staff forecasts out into the wild, and I can't imagine them being comfortable sort of taking that as given. But I'm sure something can be constructed better. Finally, I'll point out something I haven't heard in any of the coverage about SVB, but my understanding of the early days of the stress test is that the macroeconomic assumptions were vetted at the most senior levels. And a perspective brought to bear on those assumptions was how it might influence, how it might get out, and how it might reflect on what the Fed thought about what was going to happen. So it was, they were chosen as like an adverse, but not that bad. And so I've always wondered about the stress test assumptions that showed, no rate falls and no rate increases, as to whether last year the Fed was reluctant to really put in a stress test that involved the stresses that they could see were coming in the banking sector. So again, thank you both for great contributions.
Volker Wieland from Goethe University. So one thing, I want to add two things from a European perspective. So one, definitely keep these projections, the survey of the FOMC. So looking at the ECB, I've always been recommending them to actually put out something like that. So it's, the problems you might have, are worse if you are not transparent in this regard. I think the advantage of the ECB is that you have these individual forecasts, right? And it actually allows that kind of criticism, which Mickey just wrote down, right? It makes the central bank somewhat vulnerable. So so it can be improved, but I think it's much worse without something like that. That's one thing. The second thing, just also a little story from Germany and the ECB. So I was in 2021 still a member of the German Council of Economic Advisors, and we had the job, twice a year to do a forecast. So in January, February 2021, you could see that there were two surprises, upward surprises of inflation coming out of Corona. So One thing I did, and in March, end of March, we were preparing our forecast, right? So I gave some interviews to German newspapers, and just looking at the distributions, the ECB collects also an SPF, right? And you can look at a distribution of forecasts. And the risk, it's not just the point forecast, your best forecast, but also the likelihood of being 2% above or 3% above or below. And I just looked at that and then came out with a statement like, well, there is a significant risk that inflation could be 3% for the next 3 years. And that was not particularly a forecast, but just a risk from this distribution. But I think that changes the picture if someone says that. When I went to the discussion with my colleagues and we had to make our forecast, they all said, look, but the ECB says it's temporary. So we came out with a very mild forecast, just like Richard said. A lot of in early 2021, nobody was forecasting high inflation. But if you had looked at these distributions, and if someone like board members of the ECB and the Fed discuss these risks and say, well, yes, we forecast that it's temporary, but there is a significant risk that it's not temporary, and then we would do X. That would have sent a big picture, a very different message, and nobody did that. I mean, I think the central banks, ECB certainly has been unusually persistent that it's going to be a purely transitory effect until basically November, December 2021. You can find quotes. So I think these scenarios, and that links to Steve's comments, looking at these scenarios and talking about them should actually also be incentive compatible, because if you make the mistake and you never alerted to it, you're worse off, right? Now, in Europe, we had double-digit inflation. It's very hard to prove that this was a very successful central bank, right? So, it may be incentive compatible.
We have a question there. And then after this question, we'll let Mickey and Steve reply, since we're running short on time. Dennis,
Terry Anderson, Senior Fellow at the Hoover Institution. I'm not a macroeconomist, so I always learn a great deal from the panelists when they tell me about how bad the projections are or what the incentives are. But I am a political economist, public choice economist, if you will. And so when I hear that the Fed should, or that we should replace projections, or that we should allow regional to do, I think, well, who is we, or how did we make this happen? And I think, Stephen, you jumped over one of your suggestions was, well, we probably need institutional change. So my question is the same one I asked last year of one of the panels. How can this institutional change come about? How can people at the Hoover Institution or people in audiences like this help bring about the policy changes that are necessary? It won't do to just say the Fed should or Congress should. So what are the ways, the institutional underpinnings of the bad incentives that you described?
Let me start by responding to Jim Bullard and Rich Clarida. Yes, they were extraordinary circumstances and unprecedented negative supply and demand shocks, and then unprecedented monetary and fiscal stimulus, and yes, concerns about healthcare. Yet, the data started to show this dramatic acceleration, and by June of 2021, inflation had gone above 3%, and the Fed's beige book from almost every of the 12 district banks, they expressed clear observations of sharp acceleration in demand, business flexibility, business higher operating costs, business flexibility to raise prices. It reflected a combination of supply and demand, and this was also reflected in the sharp acceleration in nominal GDP. Yet, a month later, the Fed's semi-annual report to Congress basically only talked about the supply side. And so look, it's extremely difficult to forecast. And Rich, to your point, no, I'm not on that. I'm not on that Wall Street Journal list. But this is a really interesting area because the vast majority of Wall Street and professional forecasters were either trained at the Fed or they're heavily influenced by the Fed. And I can tell you the normal operation of professional forecasters is I have to come up with a number. What's the consensus? Rather than thinking conceptually. And so the private sectors, it's a lot of group speak also. And I think it's more important to think conceptually. But then I heard a number of great observations from you, all of you, about uncertainty and the failure to manage expectations. And I want to relate an interesting exercise to you. In May and June of 2020, Mike Bordeaux and Andy Levin and I were finishing up a paper on urging the Fed to use scenario analysis and incorporate it into their thinking because of the uncertainty. And so we were all holed up during the pandemic in our remote sites, and we'd have these long, long discussions about the median path of the economy and inflation and the high path and the low path. And, they would go on, these discussions would go on forever. And we wrote a paper on it. And then Andy, about every 6 months, says, we need to update that paper. And it was an NBR working paper. And of course, we all got busy and never did. But that type of scenario analysis would be just as important today as it was then, and how you would respond. And I just absolutely applaud Steve's initiative in his suggestions for thinking about how to change the SEPs, because those SEPs are the Fed's best forecasts, and based on incentives, maybe the Fed's optimal forecasts. And there are different ways you can change that, but I think it's important. Let me also say, look, inflationary expectations and the ability to manage them are critically important to anchoring inflation. But the Lucas critique taught us that in order to be credible, they have to be embedded in a model and a framework that can credibly achieve that objective. And so it takes more than just giving speeches about, our goal is to anchor inflationary expectations to our long-run target. You have to take steps in the policy steps in that direction. And, so I could talk about some other things, but fast forward to today. I mean, a year ago at this meeting, the Fed had just begun hiking rates, and the funds rate was 0.75%, and now the Fed has raised rates above core inflation, and it's really in very, very good shape. And it could come away, with a soft landing in the economy. And I would absolutely applaud the Fed if that were to pass. But now is the critical time to do that reassessment, to learn from the mistakes that were made in the last couple of years, so that these big mistakes aren't made in the future.
Okay. Steve, will that give you the last word here?
Great, thanks. So let me start with Terry Anderson's question about institutional change. One of the virtues of the Fed's rather unwieldy decentralized structure is you've got a dozen somewhat independent regional Feds. And all of the suggestions I made could be taken up by one or two Feds. Okay, certainly the conference sponsoring one, and I think my slide actually had the term, a coalition of the willing within the Fed system is all that's needed to get this off the ground. And even standing up the kinds of projections conditional on specified policy trajectories that I suggested could be done by a handful of Feds. So you don't need the board's acquiescence for that. I fully agree that getting the board to buy into the kind of suggestions I made is unlikely. But historically, some of the regional feds have played this kind of iconoclastic outsider role, the St. Louis Fed, the Minneapolis Fed. So I do think it's more than wishful thinking to believe that institutional change within some part of the decentralized Fed system can happen. You've got Fed bank presidents, they have their own career concerns that are somewhat different from people of the board. So that kind of bank level innovation has happened in the past and can happen again. To Annie Levin's point, I wasn't quite sure where you were coming from, Annie. I was trying to offer an explanation of why the doctor has not been fully forthcoming and honest with the patient, okay? And I'm with you. Better, more honesty would be good. To John Cochrane's points, I pretty much agree. I'll just quibble with one thing John said, but I largely agree. There are a lot of other conceptual issues. But John mentioned fiscal policy. Well, as I understand it, and Larry Summers made this point last year at this conference, the Phillips model suggested there'd be modest inflationary effects of this giant fiscal stimulus because of the way the Phillips model is structured, okay? That is to my way of thinking, as I outline here, that's one more example of how the incentives facing the Fed shape its analytical framework that can lead you to perspectives on where the economy's going that are off the mark. And Larry Summers was explaining, how it was off the mark and what was wrong and why he had a different analytical framework that he used. So about John's other comments about regimes and so on, the only one small quibble I would make is I don't actually think expectations are all about what regime we're in, because nobody's completely sure what regime we're in. There are many examples of central bankers giving speeches that move markets, and the only reasonable interpretation I can come up with that is they've somehow shifted expectations, even within a given monetary policy regime. But otherwise, I'm quite sympathetic to John's comments. To Rich's remarks, one of the things I liked about the incentive story that I advanced is it was not U.S. specific. It was a fundamental problem facing leading central banks around the world, which I think and diffuses to the private sector, as I very briefly tried to explain. I'll stop there.
Okay, well, we've exceeded our time limit by the optimal amount, and so we'll stop here. But let's thank our panelists here.